The Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
1490 WGCH. This is Carrie Lutz, and you're listening to the Financial Survival Network, which is brought to you by Miles Franklin. They've been in business selling gold and silver for over 20 years, and I'm a customer because when you buy, they ship. For more information, find them on the web at milesfranklin.com or give them a call at 800-822-8080 and get a free quote. If you're wondering what is up with gold, what's up with the mining stocks, what's up with the world, and what is going on, then you need to listen to Peter Grandich of Grandich.com. He's getting a lot of feedback, a lot of heat, but he's undeterred. Peter, welcome back to the Financial Survival Network. Always great to have you.
Great to be here. Undeterred, yes, but a little deterred, maybe. It's a cycle that seemingly we have to go through, and it's in the I hate you and I wish I never met you phase. So, been there before, and I just don't believe this is the end of metals and mining as we know it. And I don't know which side of the 180-degree side we're on yet, but I certainly, as I just before you and I sat down to talk, posted on my own blog that I'm just not going to sell into a black hole or buy into that this is the end as we know it. So,
yeah, well, just think, if your subscribers had purchased Facebook last week, look how much better off they would be.
Well, you know, I'm down well over 50% in my mining and exploration stock portfolio. Now, of course, that's down from what it was several months ago. What it is net, I don't know. And again, I've said this for weeks, if not months now, that a lot of the pain or the expression of pain, particularly from the public side, is coming because most people own mining shares, that gold and silver themselves are not getting hammered to the level that the mining shares are, but since most of the public is overweighted in the share side, the pain feels acute. But nevertheless, I do think that we are at a very interesting point in the gold market, and if you mind, I'll explain it a little.
Sure, please do. Tell us, where exactly are we? Because that's it. People need to see a mile marker, a milepost, so you know exactly where you're situated, where it's going.
I think the market is at a conjunction now that really should make itself clear if we look for just two things. The first I'll take is the positive. The market is now pulled back as we speak to a level that a couple weeks ago we had tested and rebounded from, and that's the 1525 to 1540 area. It's also a level that, if you go back on the charts, is where it bottomed last year when it sold off. So there is the potential now for a triple bottom. However, and I hate using that word, however, if, but, perhaps, or maybe, which seems to be the vocabulary of most forecasters, but however, until we go above the previous high, we can't consider that a bottom. So now, what I think the most prudent thing for people to do is we need to get above where we most recently rallied. So we need to get above 1,600 for a couple of days. If and when that happens, I think we can make an argument then that a triple bottom has been put in. However, if we take out these lows by more than 1 or 2%, or basically break the psychological 1,500 area, then we have to accept the fact, whether we like it or not, and I won't like it, but we'll have to accept it, that there is the potential to test the 200-day moving average, which is a couple $100 lower. Painful, can't imagine what that would be like given what the mining shares have already done, but that is one of the potential options here. what I wish for and what I expect can be two different things, but still everything still suggests that we are in a triple bottoming phase, and the next few days hopefully will show that to be the case.
Yeah, and we always have to go back to the fundamental trend, right? And the fundamental trend is there is no sign of government spending reform, cutting spending, cutting taxes. There's nothing positive on the horizon. We see socialism, nationalism sweeping Europe, and we're seeing these so-called decoupled BRICS countries are starting to get hit by the same tsunami of debt and overproduction of monetary units. So the whole reason for holding gold and silver hasn't changed, and it kind of fits in with the financial repression argument of Jim Rickards, where you dump on gold long enough in the paper markets, you bring down the price, and you make people lose faith in the only real currency, so that somehow a shift in consciousness will occur that the masses will again believe in this fiat currency that has no intrinsic value.
Well, the interesting thing about the latest term, and you always hear this term, it's not a safe haven. Well, it actually has proven to be a safe haven for those people who bought it at lower prices when there were other crises, because now they've been able to sell something that still has real value, that hasn't collapsed 30, 50, or 80%, and was liquid enough for them to get out. And I suspect that is what some of the selling we're seeing from people who are caught in other problems in financial assets and are selling down their gold holdings because it has a worthiness and provides them liquidity. So in some sense, it has fulfilled the safe haven status for people who've purchased it before. But the latest purchasers could say, well, it should be rising today. But we'll know that if we proved out and we're at substantially higher levels 6 to 12 months from now.
Yeah, and again, do you buy Facebook or do you buy some physical metal? And also, where are you finding values in the market better than in the mining sector? So many of these companies, and you published the chart about a month ago, they're worth more dead than alive. They have enough cash in the bank. They have more cash per share than the price. And that is a rather rare and remarkable phenomena, because you have so many people looking at screens that those companies that have more cash than per share than the price generally get gobbled up very quickly and find their true value. But here we've got all these stocks that are trading way, way below any measure of intrinsic value.
Well, that's the case, but 30 or 40% higher, they look like they were already at levels. And now it's just a black hole syndrome. I watched today a company that I own a lot of stock in, and I'm down hundreds of thousands of dollars in it, Alderon Iron Ore. And, on 30-something thousand shares, it loses 15 or 20% of its value. There's no logic into that, and the selling begets selling, and it creates the overdone even more so. And it always ends up having to run further than any of us imagined. And as much as I thought this time, I would see it differently, I ended up seeing it the same way, just assuming that when they get very undervalued, that's cheap, but it has to get apparently extremely undervalued. Ridiculous, I think, is the word someone used today to describe it. And you have to get to those levels. And then, as I noted on my blog, there's never a quick and easy solution. It doesn't change in a day. So I guess to sum up is we're at a good, interesting point now in gold. It has a chance to really demonstrate those of us who are bullish are right by putting in this triple bottom and rebounding and getting above 1,600. It'd clearly be best to wait to see that happen if anybody's thinking of buying. And if we're wrong and there's actually a break below this support level, then there's, we have to look, $100 or even $200 lower, and then perhaps best, depending on each and everybody's own needs and desires, to save some buying power if that actually happens.
Yeah, you never know. The market generally acts to frustrate the majority of investors, and this time is no different. And anytime you think you have a sure thing, you're going to get slammed. That's always been my experience, but I'm not overly concerned or upset. The only thing I'm upset about is I don't have more capital right at this particular moment to start buying up some of these companies that by any measure are so undervalued, and their yields have gone up so much, just their dividend yields. So now you're getting paid on a lot of these companies just to wait around for things to turn around and for them to go up. And, you just don't have that opportunity very often.
Seemingly we never do when they get really cheap, because on the way down we already assumed that they got cheap enough. I know that's been my case, and from what I gather from reasonable people who still speak in a reasonable manner.
Those few, right? Those very few.
Well, but this is, you never get truly used to it, especially when people resort to, real nastiness. Constructive criticism or people blowing off steam, it's understandable. But when people resort to something that's, just outright filthy or nasty, you wonder, what makes them tick and what was their thinking or their process. And quite frankly, as someone wrote to me, is the best advice you can give those people is buy them a mirror to find out where their true problem lays. But this is just what happens in these markets, and they go to extremes. The junior market always goes to extremes. It never has seemingly a happy plateau. It's always feast or famine, and the famine always seems to last a lot longer than the feast. And it never has a happy middle. They either go crazy to the upside or they get way, way punished to the downside. And it just seems like nothing like that is going to change. And it's been that way for almost the 30 years I've been around it.
Truer words were never spoken. So if you have to give people one word of advice, Peter, what would it be?
I don't know if there's one word at this point in time, but I think we are going to separate the men from the boys here. If those of us who have been ardent bulls were truly right about our reasons to stay strong despite real great gains already, we should see a rebound in the market in the coming days. It really should hold this support and rebound. If it don't, then some of us are going to not only have to think that the perma bears are indeed broken clock forecasters, and this is the time of day when they're right for a change. We'll have to rethink our position, but I don't think we're there yet. And I think you said at the outset that none of the fundamentals that got us here have changed, and only the emotions of the moment have gripped the market. And so we need to wait it out and see how that develops.
Yeah, totally with you on that. So patience is the byword. Don't panic. Don't give in to your emotions. Re-examine the reasons that you bought these stocks, if you bought them, and if you're planning to buy them. Look at your reasons and see if your reasons were wrong, or if the fundamentals have changed to make your theories irrelevant or incorrect, and then make a decision. Don't act on emotion. When you act on emotion in the market, you always lose money, either on the upside or the downside. You always get killed. And that's my voice of experience as someone who has not been anywhere near had your level of success in investing in the market. I know every time I've lost money, it's because I let the emotions rule. And whether you're a trader or a long-term investor, emotions will do you in every time, right?
Right, and please don't give me the credit I don't deserve. When you're down 50% plus in 90 days from where you were, I don't think you're that good, but I do appreciate your compliment anyway.
Yeah, but you do it with such grace and style, Peter. That's the key.
Well, I don't know if grace and style, walking around putting away the knives and sharp objects is style, but I think we need to wait a little bit longer before we utter the famous Fonzie "I was wrong" syndrome.
And hopefully we didn't jump the shark. So on that note, Peter, people want to find out more about you, learn more about the Grandich letter?
Grandich.com. That's where everything is.
Okay, great. Hey, we'll talk to you soon. Be well.
Thank you.